Did you know that 90% of investors lose money because of common mistakes? Or worse, are you sabotaging your financial future without even realizing it? Let's find out. Welcome back to Simply Money. Investing is one of the best ways to build wealth, but many investors unknowingly make costly mistakes. So in this video, we'll uncover these pitfalls and how to avoid them. Investors face several challenges. Number one is emotional decision-making, like panic selling during market dips. But not only do people panic sell, they greedy buy. When markets are high, they're buying in on the up climb. They're like, oh, I'm so excited. This is the next big thing. Look, it's taking off. And usually by the time you hear about it, it's already hitting its higher level, and then it starts dipping, coming back down to where it should be, getting more valuation accuracy, and you end up selling, so you take a loss. And that's typically what happens, why 90% of people make these types of mistakes. Number two is jumping into trends without proper research. Again, you see it in the news, you see a YouTube video, buy this stock, buy this ETF, whatever the case may be. And I've promoted ETFs and I've promoted investments, but I always tell you to do your own due diligence, because I'm not telling you to go buy it because it's the hot thing. I've done my research and I've found things that I like that meet my portfolio and my goals, but you still need to do your due diligence. So jumping into trends is dangerous without doing your own proper research. Make sure you understand the fundamentals of anything that you're buying into. The third thing is neglecting to diversify their portfolio. People make these mistakes. 90% of people are making these mistakes and not diversifying. Oh, NVIDIA, it's going up. Oh, look how much it's grown. I'm going to buy into NVIDIA. If I'd bought into NVIDIA in 2000, I'd be a billionaire right now, but I didn't. And I didn't buy in it into 2021 or 2022 or 2023. I owned some of it in ETFs, and it was brought in naturally as it grew, and it's helped my ETFs. But if I put everything into one stock, yes, there's a chance. And there are those that you'll read about and those you see on videos that hook you because they were one of the few, or they say they're one of the few, which is also out there, people who are lying, say, oh, I bought Facebook in its IPO, I bought NVIDIA in its IPO, and I'm a millionaire now because of this one stock. You need to buy it, or this is the next NVIDIA, you need to buy it. And whatever their purpose is, I don't know, but I'm telling you, these lack of diversification methods are very dangerous. Putting all your hopes into even a handful of stocks, even 5 or 10, unless you are professional, you truly understand financials, and you're willing to do that, I highly discourage it. That's why I encourage ETFs, mutual funds, something of that nature that is much more stable and much easier to understand and doesn't bring the risk of single stocks. So neglecting to diversify and these behaviors, all three of these, emotional decision-making, jumping into trends, and neglecting to diversify, can lead to poor returns and unnecessary losses, turning what should be a wealth-building tool into a financial trap. Now let's look at the 5 biggest investing mistakes and their impact. Because it's not just important to look at what are the mistakes, but what is the impact of these mistakes? We have 5 of them. Number 1 is chasing the hot stock. Jumping on the bandwagon often leads to buying high and selling low. We just touched on that. You are not going to get the insight of the next upcoming stock unless you are a professional. And even then, they lose money. The reason that financial advisors look so well off is because they make money whether you do or not. If you invest $100,000 with your financial advisor and you lose $50,000, guess what? They still made money. They don't make money only if you win, only if you succeed. They make money for managing it whether you make money or not. Not saying that they're greedy or they're bad, but just understand financial advisors make money by the amount of portfolio they're managing, assets under management. They get an asset under management, AUM fee. The more they have, the more they make. Another reason, another video we can do on why Financial advisors often say, oh, you need $5 million before you can retire. They don't want you drawing down their AUM, their assets under management, because that is reducing their money, their commissions. Not all of them. Don't take this like, oh, they're all evil and bad. But there are those out there, they only care about their commission, and they'll tell you advice that sounds good, but they're there for their pocket. And so do your due diligence even with finding a financial advisor. Find a financial advisor who's fee only, meaning they only charge you when you're sitting down with them. They're not making money based on the amount of portfolio you have. They charge you per hour to sit with them. So you do an annual check-in with them or whatever the case may be, and you pay that amount, and it doesn't impact your portfolio. And make sure they're a fiduciary, somebody that has your financial best interest, and they're bound by law to do so, and they can't sell you only what is based on what is best for them in commission. Number 2 biggest mistake is timing the market. Trying to predict highs and lows is nearly impossible and can hurt long-term growth. Nobody knows what the market's going to do. Don't believe anybody that says this is the low or this is the high. When you buy in and sell on highs and lows, you end up hurting your long-term. Buy and consistently buy. I like dollar cost averaging because each month, each paycheck, whatever it may be, I put X number of dollars toward investing into certain funds, and I sometimes buy when it's a little high. Sometimes I buy when it's a little low. But over the course of 10, 20, 30 years, it's averaged out. And I've bought at some highs, I've bought at some lows, I've hit some peaks, I've hit some valleys. I've got a good return on my investment. Number 3 mistake is neglecting diversification. Putting all your money into one stock or sector is risky. So what some people will do is say, oh, I'm diversified. I'm in this ETF or this fund. It has 20 or even 100 different stocks. And that's wonderful. I'm diversified. But all of those stocks are in one sector. I'll give you an example. There's an ETF that I have, and this is me not telling you to buy this. I own SOXX. Just a very small part of my portfolio, something I wanted to do for its upside. I know it has tremendous downside as well. I know the beta is very high. It is very volatile. It's the most volatile ETF I have in my entire portfolio. I put a small percentage into that. But if I wasn't aware of what I was doing, I could say, oh, look, I'm into SOXX. It's diversified. It has, I forget what it is, like 30 different stocks. That's wonderful, but they're all in the same sector. They're all AI microchip focused stocks. That is one sector. If that sector does great, like the forecasts are saying it should, then wonderful. But if that sector doesn't, then you lose and you have nothing to balance it. Now, in my situation, because it's a small percentage, and I did it for really, if I can say, for fun, is a small portion of my portfolio for growth potential. If it takes off, it's not going to do a whole lot because it's a very small percentage of my portfolio. Yes, it'll be nice. The return on investment will be great. And if that sector doesn't pan out to what the forecast are showing it to be, then I'm not out a ton. I'm not going to lose all my money because it is diversified in that sense, but it is still an opportunity for me to lose some of the money that I invested. But that's my point, is you can't look at something that is an ETF if it's high concentration in one sector. There's a lot of ETFs. They're very diversified. Could have 100, 200, 300 stocks, and that's great diversification, but 50% of it could be technology, which is one sector. So you want to be diversified in your stocks, the number of stocks and companies you own, but also in the sectors. You want to be in financials. You want to be in consumer goods. You want to be in technology. You want to be in all these energy and different industries and sectors to make sure, because some of them are going to go high while others are low and vice versa, and they balance each other out. And you want to make sure that you have that diversification there as well. So neglecting diversification. Number 4 is ignoring fees. High fees or funds on advisors eat into your returns over time. That's why I like low cost, low expense ratios for my index or ETFs. Like SCHD is 0.06. I have some that they're maybe point or a little bit higher. But you could be, and again, that's a small percentage of my portfolio. You could be into a fund that looks like, oh, the return looks really good, but it has a 2% expense ratio. You got to reduce the amount that you're actually getting on your return by 2% because they're taking that fee. And advisors that you use, that you give them your portfolio and they're taking 1% management fee, and then maybe some of them even have transaction fees. Every time you make a transaction, there's a fee. They have monthly maintenance fees. There's a lot of little fees you have to look out for. Make sure you're reading the fine print and know and understand all the fees that you'll be paying, because it can eat at and erode your wealth. And the fifth biggest investment mistake people make is emotional trading. Making decisions based on fear or greed rather than solid strategy can derail your investments. I encourage you to read Psychology of Money. You can grab a copy in a link below down in my description, along with some other books that I highly recommend. But Psychology of Money really gives you the understanding of how you think about money, because everybody thinks about money differently depending on their upbringing, their environment, their culture, all sorts of factors. How do you think about money? And if you're investing, making emotional, fear or greed-based decisions, those are the 5 biggest investing mistakes and their impact. The biggest mistake, letting emotions drive your investments. Fear during a downturn or greed during a rally can lead to rash decisions that cost you big time. For example, selling during a market crash locks in those losses, while staying invested often leads to recovery. That's right. Think most recently, COVID 2020 in March, April, the market crashed hard and people panicked and sold. They locked in that loss. And guess what? By June, July, August, it had recovered and surpassed that. They weren't able to get that recovery because they'd already locked in their losses. Think about the stock market. If you're invested, you're not losing money when the market's down. Your portfolio value has, but you haven't locked it in. You don't lose money until you sell. You don't make money until you sell. So your unrealized losses and gains, if you ever look at that, means exactly that. They're unrealized. They're not real. You haven't locked them in. They become realized gains or realized losses when you sell. Ride out that and wait for the recovery. It's okay. Learning to control your emotions is the key to long-term success. Investing isn't about quick wins. Let me say that again. Investing isn't about quick wins. Yes, it's nice to look at your portfolio and to see it went up 5% this week. That's wonderful. That's not what it's about. I encourage you, if you can't handle the emotional roller coaster, don't look at it too often. Look at it every quarter, every 6 months. You don't have to worry about it long term. You know, some of the wealthiest people actually got there by mistake. They did some of the most important things. They started young. They went into their company, got a job, contributed to their 401k, set it into some good and strong mutual funds, and left it. And they forgot about it. Basically, they just kept their paycheck. It was automatically taken out. They had company matches, and that money just went in there for 20, 30, 40 years. Then they go to retire and they get their 401k and they're like, holy cow, look how much money's in there. Because they didn't fiddle with it. They didn't mess with it. They just let it sit and ride. If they had been paying attention to it, they may have sold or traded and said, oh, I got to get out of this. It's dropping. Oh, I want to get into that. It's increasing. And they would have messed things up. Sometimes just getting into it, leaving it alone, and stop fiddling with it so much will help you meet your financial goals. It's about consistency and avoiding these common mistakes. By staying informed and disciplined, you can set yourself up for financial success and financial freedom. What are your thoughts? What are some major mistakes you've made? I've made mistakes. When I first started investing, I did the very same thing. I found some stocks that I thought, oh, these are going to be up and coming, and then they didn't work out, and I sold them, took slight losses, and rolled that money into something else. And then thankfully, I learned to get into mutual funds and then ETFs, and I was able to roll that money in and set it and leave it. And I've left that money alone. Now I've diversified and managed my portfolio as I've learned more. But what are some things you've learned by mistakes you've made? What are some things you've learned by successes that you've had? Leave a comment for everyone in the group below. And if you like this video, hit that like and subscribe button, and we'll see you next time on Simply Money.